Hi, Bill Burke here. I'm the Managing Director for Ground Rush Financial, and so we're doing these series of videos to give you some help on approaching people and what might you say to them, what circumstances might show up. So today what we're going to talk about is a case that I'm working on right now, and this is a gentleman who knows a couple of people who are together, but they are worried about their financial situation in their 60s. And there is a $3 million Schwab account, and they have no other real safe assets, but they're really worried about the future and how they're going to make money. So the question is, all right, what are we going to do about the Schwab account, and what are their big risks? So let's talk today as we go through this. And I sent this to my friend, and he's preparing for this. He's out of town right now, but we're going to prepare this and show this to these couple of ladies who run this business, and we'll go from there, and I'll show you how this works. So one of the big issues you have to deal with early on with people who work with Schwab or have any major stock brokerage account is you've got to be aware of the sequence of returns. Now, we've identified the sequence of returns official definition here for you, but I want you to read this, because what it basically says is this. Sequence of returns is, as returns come in, what do they mean? Well, when you're growing your assets, sequence doesn't mean anything. But when you are taking money out in retirement, the risk is that the market declines in the early years of retirement, paired with ongoing withdrawals, could significantly reduce the longevity of a portfolio. Now, this is a risk that no one knows about, no one thinks about, and when you talk about doing a test drive for a retirement plan, one of the comments you make is, well, have you test-driven your retirement plan to see how it's going to respond to sequence of returns? And frankly, nobody really knows what I'm talking about, because they've lived with a growth advisor who has never talked about sequence of returns and is not prepared to handle sequence of returns. And the reason this is so important is John Bogle, who founded Vanguard, the big index funds. He was a pioneer in the index industry. Bogle said a couple years ago, retirement is like a lottery. You either retire in a good market or you retire in a bad market. And I'm going to show you what that means right now. And I'm going to also go with the premise, everybody, that nobody really wants to take the risk at age 65 or 70 to roll the dice and say, I hope I'm lucky, because that's not going to be a great retirement. So here's what happened, what we did here. So I also put up here the big theme that everybody hears for the last 30 or 40 years from their growth advisor, and the growth advisor is exactly correct on this. Number one, don't worry, the market always rebounds. Number one, that's true, isn't it? Look at the charts, they always rebound. And number two, by the way, you're always in this for the long haul. Now, I would say to you, when you get older, two things happen. Number one, will the market bounce back fast enough? And number two, are you in this for the long haul anymore? I would tell you, at my age, at 74, the long haul is becoming shorter, albeit I'm healthy, but I'm not looking 30 years ahead right now. I need to make sure things happen right now. So that's a key element you've got to keep in the back of your mind, because your clients are hearing that all the time from their advisors, all the time. Now, what I'm also going to offer to somebody is, what does the investment mix look like? So I asked this person, I said, I'd like to see their Schwab statement. Well, the reason I want to see their Schwab statement is because I want to know what is the risk volatility of their portfolio. Now, what I'm showing you here is I do this on point. It's a system I have, and it basically measures companies. So what you're going to see here, and I sent this to this gentleman this morning, because the question is, how do we get these people to say, gosh, I'll let you look at my Schwab accounts so I can take the symbols for their stocks, and we'll see what it looks like. So let's take an example. Hewlett-Packard, first example here. The score is 100. Now, 100 is the top risk score. What risk score is based on miles per hour. So 100 means you're going 100 miles an hour, and if you are not used to that, that is way above your speed limit. Bad things happen when you go past the speed limit. And that's what happens here. So look at this chart. Hewlett-Packard, for the last average return for the last 5 years has been 2.98%. It has, but look at the max drawdown. When you look at this chart, the blue line represents the accumulation phase, But the red lines represent the drawdowns. Now think about this. If we go by sequence of returns and you use this and the drawdowns here, when you look at this chart closely, 27%, 35%, 49%. That means this stock dropped. And if you look at the law of large numbers, if you have $1,000 and you lose $500, that's a 50% loss. But to get back to 1,000, it's a 100% gain. So if you look at this, what I want to retire knowing that I could end up facing a 35% loss in my account. Now, the next one we look at, and they're all about the same, United Airlines. United Airlines is a 100 score. They've had 62% losses, drawdowns, 35%, 82%. That's a very disturbing graph if that was what your retirement was in. How about Albertsons Company, Safeway? Safeway's a 97% risk, and it also does not look very good, but its growth has been okay, but even that has been sort of anemic. And then we have General Motors. 100 is the risk score. Now, the losses in the last couple of years, 39%, 46%, 47%, not a good scenario if this is your big part of your return. Again, we'll talk about why this matters with sequence of returns. And the risk score for Philip Morris is 87, the same patterns. Here is Johnson & Johnson, 58% risk score. But look at the volatility. I mean, it's been down 9, 11, 12, 13. But talk about every year it's changed. That's, again, something we got to worry about. Now, this final chart I'm going to show you is the power of indexing and what it means when the index or a stock market drops. So what this simply says is we have an index, the green lines, that say they go up until through 2020, and you will notice it's a 6% in cumulative return or compounded term. It exceeds the market for that whole time frame. But look what happens to the market. The market in 2020, this COVID drop, the market dropped 26%. The average return was 4.42%. After all that time, for 20 years, you average 4.42% because the market dropped right at the end. That's the challenge. So what does sequence of returns really mean? So this is what I show clients, and I sent this off, and this has become a very effective tool. When I look at the concept of sequence of returns, we know if we take a look at the S&P 500 back to 1928, there's a chart here, and the graphic simply looks like an EKG, and it says for the last 50 or 60 years, 74% of the time the market has been up. 26% of the time it's been negative, but the average return, because we didn't worry about taking money out, was somewhere between 8 to 9%. That's the average. Now the question we come to is when you retire, whether it's 2022 or 2023 or 3030, what will the market do? How will it perform? Will you be lucky and it'll be going bonkers like it has been the last 10 years, or you'll be unlucky as it was in 2000 or 2008 and dropping when you retire? Well, let's take a look at what happens next. So I'm going to go back to this chart. This is 2000 and then 2008. This is the 12 years in which the market was flat. It was probably the worst time in our history. And for those of us who were accumulating in our 401k plans, nobody worried about it because they weren't taking money out. But all of you know somebody who was in their 60s who retired in 2000 or retired in 2008 and lost everything or had to go back to work because their retirement was destroyed because they're pulling money out in a down market. That is the sequence of returns, risk. So what I'm asking is, do people think this could happen again? Now, for someone who says, no, it's never going to happen, the market's going to go up forever, then they're not going to be a candidate. But the question is, all right, what is going to happen and how do we avoid this? So with this chart is, I'm going to not spend tons of time on it, but this is the accumulation phase. On the right-hand side, you're going to see that both those graphics happen to equal 7.0%, and they both equaled 493,000. Now, to make this clear, if you look at the red, the 28.71% at the end, If you go back to the bottom of the blue, there's 28% at the beginning of the blue. So these are just graphs completely reversed. So I want you to think about this. The one investment started at a 20% uptick. They grew at 1831. Look at the growth, a 26% increase. It dropped 37%. That was 2008. Grew again, dropped 20, then it dropped another 22%. But that was an interesting chart. Now, if you take the exact reverse, if you started -9, -11, -22, and then grow, this investment was pulled out of the fire, and at the end, it also came up to 493,000. Very interesting. So that average rate of return was 7%. That was terrific, but but sequence of returns is not about that. We're now going to take a look at what you really want to do. And this little fun chart basically says, look, if you're going to go in retirement, it's going to like an amusement park. It's going to be fun, exciting, but you only get to get in and stay there if you got enough money. So here, if you had 700,000 and you've got a reasonable return, it might last 54,000 a year for income for the rest of your life. But if you need 8% or you need 4%, at an 8% growth or a 4% growth, your years run out. You don't have enough money, and that's the challenge. And if you have sequence of returns, if you lose money, it even gets worse. So here's the other point to recognize. Will you be 100? Now, 30 years ago, we didn't worry about retirement because people were dying at 70 and 80. But now that there are 70 million baby boomers who are now living into their 90s. The question is, are you going to be okay until 100? And the real question is, at age 85, should your portfolio be at risk where suddenly retirement doesn't look so hot, and now you're saying, gosh, I've got to change everything because these golden years are turning into some pretty nasty surprises I didn't expect. So let's just give you an example where sequence fits. So here's a lady, has a $500,000 IRA, and she's going to pull out $30,000 a year in distributions. And she starts with a $500,000 portfolio, and the graphic we're showing here is she starts, as we did before, in a good market. So she starts and her $500,000 grows to $600,000, goes up to $885,000. There's a drop, it grows again up to $2.4 million, drops down to $1.4 million, ramps up again to $2.4 million, drops again by $1 million. So when she gets out there, she's pulled out her income, but she's left with $1,400,000, which is not bad. But if she starts unlucky, her $500,000 drops dramatically until she gets 5 years into the plan. She's got half of what she started with. So now here she is, 70 years old, half of her portfolio gone, looking forward to another maybe 30 years. What does she do? That's the problem. And you can't revisit your decision. You've got to begin to plan for that. So graphically, that's one thing. But what I showed you is Diane here. In this example, she's lucky. She has a $500,000 portfolio. She wants to pull out 5% or $25,000. And she wants to include a 3% inflation factor. So the middle column here, this 25, 750, this middle column is what she wants. That's the plan. And it grows to a $50,000 income. But look at her return, her market performance, 12%, 23, 26. She's exceeding that 5% growth requirement. So by the time she ends up at 71 years old, she's got $827,000. And then gets hit with a 38% loss, drops it down to $490,000, and then ramps back up because the market accumulates again. And then she, again, has another couple downturns, a couple more drawdowns. But look what happened. The beginning of the market gave her enough growth to sustain the future losses. What happened with her friend, Jack, was not so good because Jack hit the bad market. He was unlucky. So he started -10, -13, -23, exactly the same goal, same portfolio, same rate of return he wanted, same 3% inflation, and he simply runs out of money at age 82. And I want you to think about Jack. Here he is, he's 70 years old, he's got $228,000 left in his portfolio. What will he change? Is he going to move? Is he going to work on reducing his meals, transportation? What is he going to do? That is a question that is out there. And our role is to say, you want to avoid this. Our job is to say, we have to test drive your retirement plan to make sure you are not subject to this sequence of returns risk, because that's not a good place to be at age 85. Because now you're going to have a desperate time, and you're going to not be independent, you're going to be dependent. And that is not what you dreamed about. So that's what we're going to try to talk about with this future client, is how do we avoid the risk of sequence of returns, and that's what our products will do. So that's our story for today.